All right, today we're tackling a real titan of Indian finance, Bajaj Finance. You see the name everywhere, right? But is all that hype justified? We're going to deconstruct it using a fantastic deep dive report from Web Cornucopia Finance to see what's really going on under the hood.
To even begin to get your head around Bajaj, you have to start with this one number: 72 million customers. I mean, to put that into perspective, that's more people than live in the entire United Kingdom. This isn't just some company, it's a financial force that's literally woven into the daily lives of tens of millions.
And that massive scale, it all boils down to one question, right? The question that really matters for anyone watching this. Is Bajaj Finance actually a good investment? Let's dig in and find out.
So what's the verdict? Well, the Web Cornucopia report slaps a score on it, 8.4 out of 10. Now that's pretty darn good, but hey, it's not a perfect 10. And that's where the real story is, you know? It's in that gap. So we're going to break down exactly how they got to this score, piece by piece.
Okay, first things first, financial health. Because, before you even think about growth or fancy strategies, you gotta ask, just how solid is the foundation this whole thing is built on? And right off the bat, this just jumps out at you. Return on equity, or ROE. Think of it like this. It's a report card for how good a company is at turning its own cash into more cash. At almost 22%, Bajaj is getting a clear A+. Meanwhile, the rest of the industry is kind of hovering around a B. They are simply way more profitable with the money they have.
Now, you'd probably think, okay, making more money must mean taking on bigger risks, right? Well, think again. This chart here shows their bad loans, what the pros call non-performing assets. Bajaj's are literally half the industry average. So just let that sink in for a second. They are making more profit while taking on less risk. I mean, that's the absolute holy grail in banking. So when you pull all these numbers together, the picture becomes crystal clear. The report is basically describing a financial fortress. It's safer, it's more profitable, more efficient, and it's growing faster than its rivals. This ridiculously strong foundation is what gives them the license to be so ambitious.
All right, so that financial health, that's the engine. A really, really powerful one. Now, let's check out the racetrack itself. Just how fast is this company moving? And who's in the rearview mirror trying to catch up? This timeline showing their assets under management, basically how much money they're handling, is just wow. Forget steady growth, this is just explosive. According to the report, they're on track to nearly triple their assets in just 5 years. That's not just growth, that's the kind of hypergrowth that puts a company on a whole different level.
So what's fueling this rocket ship? The report says they're basically riding this perfect wave of trends in India. You've got a huge, ambitious population that's hungry for credit, and at the exact same time, digital payments are just exploding. Bajaj has managed to plant itself right in the eye of that storm.
But hey, they're not the only car on this racetrack. And the report does a great job of showing both sides of the coin here. On one hand, yes, they're the market leader with a trusted brand and fantastic tech. But on the other hand, the competition is absolutely fierce. You've got the big traditional banks getting more aggressive, and all these nimble fintech startups are constantly trying to shake things up. And all that competition? It drives up the cost of finding new customers for everybody.
So this all leads to a really important kind of qualitative question. What about the leadership? What's their secret sauce? What is it that lets them not just survive, but actually thrive with all that intense competition? What makes them so special?
The report argues their real edge is a 4-part moat that protects their business castle. And it's a brilliant cycle. It all starts with a brand that people genuinely trust. That trust opens the door to a massive network of partners. We're talking over 4,000 locations. That huge network runs on a super efficient tech platform. And that platform, it's a data gathering machine, which lets them make smarter, faster decisions than pretty much anyone else. See how each piece feeds the next? It's a powerful, self-reinforcing loop.
And look, if you need just one stat to prove this management team isn't just talk, the report gives us this beauty. They grew the assets they manage from 35,000 crores to over 3 lakh crores, a nearly 10-fold increase in a single decade. That doesn't happen by accident.
That is a track record of absolutely world-class execution.
So, we've established it's a fantastic, incredibly well-run company. But, and this is the big but, that leads us to the million-dollar question. Or I guess in this case, the 7,000 rupee question. Is the price right? Let's unpack the valuation.
And here it is. Here's the catch. This is the price-to-earnings ratio. It's basically how much the market is willing to pay for 1 rupee of a company's profit. For your average competitor, you pay about 18.5 rupees. For Bajaj, you have to pay over 62. The market is not dumb. It knows this is a fantastic company, and boy is it charging a serious premium for it.
So to figure out if that premium is even worth it, the report uses a method called discounted cash flow analysis, or DCF. Now, don't let the fancy name scare you. In simple terms, it's just a way to calculate what the company should be worth today based on all the cash it's probably going to make in the future.
And this analysis gives us 3 possible futures. There's a bear case, if things go kind of sour, which values the stock around 5,200 rupees. Then there's the bull case, if everything goes perfectly, putting it way up at 9,500. But the report's most probable base case, that lands on a fair value of about 7,200 rupees per share.
In that base case, that 7,200 rupee target is what leads to the report's final verdict, a buy. The analysis concludes that even at its premium price, the company's powerful growth engine justifies a higher valuation than where it is today.
And this chart brings us right back to the beginning. It's perfect. Look at how those individual scores create that final 8.4. Financial health, management quality, growth prospects, all scoring exceptionally high, right? But then you see that valuation score. At just 6.2, it's the one factor pulling the overall score down. This perfectly visualizes the core story. An amazing business that comes at a high price.
So, we've deconstructed the hype. The Web Cornucopia report paints a clear picture of a best-in-class company firing on all cylinders, but with a valuation to match. And that leaves us with the ultimate question for any investor to ponder. What is the right price to pay for excellence?